All right. Transaction analysis sheets are basically impractical and they're not usually used or they're not used in the real world. Okay. Um, we use them in the introductory accounting course to show you how a transaction affects different accounts. But, okay, transaction analysis sheets are impractical. Okay, they simply would be too long. Okay, for a large company who has thousands upon thousands of transactions each day. So it's easier to keep transactions or keep track of transactions using separate accounts. Okay, so we're going to start with the simplest of accounts, and that's a T account. And basically, it is, or it looks like a T, and it has the account title at the top. Now, the left hand side of the T is called the debit side, or the DR side, and the credit side is the right hand side. So you're going to have a separate T account for every account the company uses. So you'll have one for cash, one for accounts receivable, supplies, for mortgage, for accounts payable, for the capital account. So there's a separate account for each account that the company uses. Now, this is the information that's very important. Okay? Now, every question is going to start with opening balances, and these balances you're going to take from a balance sheet. So asset opening balances, so for an asset, any asset, the opening balance is going to be on the debit side. For liabilities and for owner's equity, the opening balances are going to be on the credit side. Okay, just like this. So cash, in this case, has an opening balance of $6,200. Okay. For accounts payable, you notice, okay, the opening balance is on the credit side, or, okay, the right-hand side of the account. All right, now, the most important thing in accounting is understanding debit and credit theory. Now, the rules in regards to debit and credit theory is to increase an account, prepare an entry on the same side as it appears in the accounting equation. So here's our basic accounting equation. So assets are on the left-hand side of equals, so they increase on the left-hand side of a T account. So they increase on the debit side of a T account. Liabilities and owner's equity are on the right-hand side of equals. So they're going to increase on the right-hand side of a T account, so on the credit side. Now, to decrease an account, you prepare an entry on the opposite side as it appears in the accounting equation. So to decrease an asset, you're going to credit. To decrease a liability, you're going to debit. Now, graphically, the rules are this, right? So assets increase on the debit side, the left-hand side of a T account, and decrease on the right-hand side of the T account. Liabilities decrease on the debit side and increase on the credit side. Owner's equity follows the same rules as liabilities. Now, in accounting, we follow something called the double entry accounting principle. And basically what that says is if we debit something for $500, that means we have to credit something for $500. So for every debit, there has to be an equal credit. Now you could debit something for $1,000, but you would need credits equal to $1,000 as well. It doesn't necessarily have to be one and one. It could be one. You could have three accounts affected. So one debited for $1,000 and two credited for $500. All right. So when you're recording transactions, basically you're going to have to ask yourself four things. What accounts are affected? What types of accounts are they? Are they assets, liabilities, or owner's equity? Am I going to increase or decrease the account? And ultimately, will I debit the account or credit the account? All right, so let's look at this example and worry about these four questions. So now, this is all going to be done in your head, okay? So you don't actually have to write anything down. So let's suppose on July 1st, we receive $1,000 from a customer who previously bought on account. So what accounts are affected? One is let's go back. One is cash, and the other one is accounts receivable, right? Because now they owe us the money. Now, cash is what kind of account? It's an asset. And accounts receivable is also an asset. Now, what's happening to our cash if we receive $1,000? It's going to go up. So it's going to increase. Now, for accounts receivable, if the customer pays us, they no longer owe us the money. So accounts receivable is going to go down. Now, cash, which is an asset, needs to increase. So are we going to debit or are we going to credit? So we're going to debit that account. Accounts receivable is an asset and we need it to decrease. So automatically I know it's a credit because for every debit there has to be a credit, right? All right, so let's assume on July 2nd now that I purchased $500 worth of supplies on account. So what accounts are affected? Supplies is one, and accounts payable, right? Because now I owe the money. Now, supplies is an asset account, and accounts payable is a liability. Now, what's happening to our supplies? Our supplies are going up, and accounts payable. Do I owe more now, or do I owe less? I owe more, so it's going to increase. Now, supplies is an asset, and it needs to increase, so I'm going to debit, and accounts payable is a liability, and it needs to increase, so it's going to be credited. All right, example number 3. On July 3rd, the owner personally buys a $10,000 truck for the company. So, one account is truck, and the other account is capital or owner's equity. Now, truck is an asset, and owner's equity is an owner's equity account. So, truck is going to go up, right? And owner's equity, whenever the owner gives the business anything, the value of the business goes up. So owner's equity is going to increase. So how do I make an asset increase? I debit, and to make owner's equity increase, I credit that account. All right, so what we're going to do is we're going to put all this together. Now, we're going to start off with opening balances. So these will be given to you in a balance sheet at the beginning of the question. And what you're going to do is you are going to put these opening balances in. So basically what's going to happen is you're going to put the date, okay, the opening balances were listed at. So cash, the opening balances for assets, remember, go on the debit side. So for accounts receivable, okay, opening balances will go on this side. Okay. Oops. Let's leave that the way it is. All right. So again, you're going to put the opening balance for accounts receivable on the debit side, for equipment on the debit side, Okay, accounts payable, it goes on the credit side, and for capital, it goes on the credit side. Now, what we're going to do is we're going to go back and we're going to read this transaction. So what happened? We received $1,000 from a customer who bought on account. So if you remember, okay, cash goes up on July 1st for $1,000. And accounts receivable is also going to go down, so we credit for $1,000 on July 1st. Okay? So that transaction has now been recorded. Now, if we remember, in the second one, we purchased $500 worth of supplies on account. So, if you remember, so supplies, we bought $500 worth of supplies. So on July, we're going to record on July 2nd a debit of 500 and, okay. Okay, so we record that we now owe $500 more. Okay, so I have a debit and I have a credit. Okay, and in the last transaction, the owner bought a $10,000 truck for the company. Okay, so truck on the 3rd, we're going to debit for $10,000, and then the capital account we're going to credit for $10,000. Okay. Now, once we've recorded all those transactions, let's assume that there's no more. Okay. What we're going to do is we are going to total up the accounts. Now, if there's only one item in the account, you can just circle it, right? So there were 3 with only one transaction. Now, if there's transactions only on one side, then what you can do is you can draw a subtotal line and then add these up and put the balance on the same side. So circle up the balance. Okay, so for here, okay, and for here. Now, if there's items on both sides, what you're going to do is you're going to subtract the smaller one, the smaller value, from the larger value, and put the difference on the larger side, and then circle it. Okay? Now, what happens if I have multiple debits and credits? Okay, so for example, I have this. What you're going to need to do is you're going to have to come up with subtotals for each side, and then come up with a final total and put it on the larger side. All right, so you'll notice that dollar signs are placed at the top, on the first numbers, for subtotals, and then for a final total. Remember, the final total is always circled in each T count. And we're going to define we're going to find a group of T counts as a ledger. It's basically a group of accounts. All right.